Hello and welcome to the Bloomberg Canadian Fixed Income Conference. Today I'm very pleased to welcome Tamara Lawson from QuadReal. She's the Chief Financial Officer there. Also Cecilia Williams at Allied REIT, also Chief Financial Officer, and Peter Sweeney at SmartCentres, Chief Financial Officer. We have three Chief Financial Officers with us today. And I'd like to start by asking you all, and maybe Cecilia, you can take this question to begin with. So there is no end date for COVID. Real estate investment trusts have been beaten up quite badly since the start of lockdowns. We see that the overall S&P Toronto Composite Index is down something like 4% this year, where the real estate sub-index, which comprises mostly REITs, is down more like 20%. So obviously there's some negative sentiment around REITs. How are you feeling at the moment about, can you just walk me through how you're thinking about the risks and the uncertainties for your business at the moment?
Absolutely. Thank you for having me on this panel. It certainly is very different from the situation that my peers on this panel, what we were experiencing a year ago when we were in New York actually doing this live, which seems like a dream now, thinking back. I feel like Allied has always been preparing almost for a situation like this, where there's a lot of uncertainty, and now we can almost see things in action. And for those of us that didn't live through the real estate meltdown in the early 90s, it's really certain things coming to life. And this is me trying to see the positive in this situation. And, you can read about crisis management all you want, but actually having to go through it as a leader, as a manager is quite different. So from there are different aspects to this, of course. So financially, Allied, we've always been very conservative. And so we've always thought very hard about our debt metrics and how do we make sure that we're never caught in a situation where we're unable to execute on our strategy. So keeping low debt metrics means that we can do that even today. And so we have a lot of liquidity. We're in a position where we won't need to go to either the debt or the equity capital markets. We can fund everything through 2021 with a lot of certainty in terms of how we will meet our commitments, certainly for development and in terms of our current portfolio. Operationally, the focus has really been with our tenants about how do we make sure that people feel safe in our buildings as they slowly start to come back to the office. Vancouver started to repopulate in May. Middle of May is when we started having our office tenants come back. So we're roughly at about 60% repopulation there, 95% on the retail side. Calgary reopened in June, and there we're at about 30% office repopulation, 30% on the retail side. And then Montreal and Toronto were both reopened in early July, and there we're at about, our office space is about 20% repopulation and 95% on the retail side. So I feel like things have been going in the right direction with more visibility now than there was at the beginning. But that's assuming that things continue with the reopening based on the numbers that we've seen today, which I believe are the highest since the reopening. That might shift a bit.
Tamara, how would you respond? How are you thinking about the risks and the uncertainties at the moment in your business?
Well, thanks also for having me today. And I agree, this is a very, very different environment than we were in a year ago, but we're doing this. So I think it shows that people are very adaptable. Companies are adaptable, and we've been adapting to this new environment. Similar to Cecile, I think we were preparing for a recession. We did not foresee, obviously, a pandemic, but we did feel that we were late in the economic cycle. And we'd already begun planning for a recession, and we'd added liquidity sources, and we're keeping leverage low, below our long-term target in response. On the investment strategy side, our investment strategy and our active management have been critical factors in minimizing the impact of COVID. Our limited exposure and underweighting in more impacted asset classes have really helped us to minimize the impact. And as Cecile mentioned, on the operational side of things, that's been a big focus. We've been really providing a lot of support to our employees and our tenants, especially our frontline workers who are located at our properties. This has been a priority. We've been very focused on providing support to our tenants. We've supported them in the CECRA program, for example, and developed a tenant tool to help them with that program. And we've been really communicating to our employees on a more frequent basis and really increased activities around employment engagement, just to ensure that everyone is working effectively and has the tools that they really need to work remotely. We've been in constant contact with BCI and our third-party clients to make sure that they're completely up to speed about what's going on and what actions we're taking. And then to offset the impact on revenues that we've seen, we've tightened our expense control and also deferred non-essential capital expenditures where possible. And on the liability management side, we've increased liquidity sources as rates have declined and credit spreads normalized, and we've raised additional capital. And we've also fast-tracked workplace efficiencies and accelerated technology investments in response to the impact of COVID. And finally, I would say we've invested in some new initiatives that really capture future opportunity and value.
Peter, if I get your opinion, I mean, your business, because of its weighting more heavily towards retail, in some ways has had the most challenging, perhaps, environment. How do you think about the risks and the uncertainties to your business going forward?
It's a great question. We scratch our heads, frankly, a little bit here at SmartCentres. Our units are currently trading at a level that is yielding a distribution rate of almost 9%. And for a company of our size, given the alternative initiatives that we have moving forward, mixed use initiatives and the expectations for those initiatives, we struggle to understand why the market currently is discounting us at the level and to the levels that they are. I think it's fair to say there is a level of negative sentiment in the marketplace for anything that has a retail connotation associated with it. And so, because we're painted with the same broad brush, and because our platform, historically at least, has been predicated on having open format Walmart anchored shopping centers that are predominantly retail in focus, we do get painted with that same brush. But I think it's generally known that an open format shopping center in this environment has a much larger stable of tenants that are open, of shoppers and patrons who are visiting those open format shopping centers, certainly on a relative basis to an indoor or an enclosed shopping center. So, we struggle, frankly. We struggle to understand the market. As we all know, the markets are fickle. And at least for now, sentiment seems to be on the side of multi-res type investment. We're hoping that over the course of time, as we unveil our mixed-use development strategy, which includes a lot of multi-res development, some condo development, senior citizens housing, as well as self-storage facilities, that the market will be receptive, because for us, having a Walmart anchored shopping center portfolio provides us with a safe, secure, and very frankly stable basis upon which to catapult and lever our growth for the future. I think it's safe to say that we're blessed with that, but it didn't happen by accident. The reality is the portfolio was built for heavy weather. It was built for sort of stormy weather when there may be some challenges. And notwithstanding, what we're going through today as a society, our retail portfolio continues to outperform, and we continue to enjoy relatively high rates of occupancy. And that doesn't suggest for a moment that tenants aren't feeling it and that there's some retail tenants that may not be able to survive for lots of different reasons. But the reality is, our shopping centers continue to be high traffic, visited by high traffic areas and visited by consumers across Canada. So we're hoping that, again, in the fullness of time, given that we're starting now just this quarter, in fact, Q3 of 2020, to start enjoying the benefits of some of the condominium closings that we've been speaking about now for almost 3 years, that will at least give investors further confidence in SmartCentres as an entity that has catapulted itself from what was previously an entity focused almost exclusively on retail type investments to one that is now becoming multi-directional and multifaceted. So it's a long-winded answer, I think, Chris, but at least it perhaps gives you a perspective on how we at SmartCentres think of what we're enduring currently and perhaps the way we see the markets, and hoping that, confidence in SmartCentres at least will return sooner much rather than later.
Tamara, if I could ask you, maybe, and you're not a publicly traded company, so you don't disclose metrics in the same way as Peter and Cecilia, but one key metric for your business is collection rates, and I wonder if I could just get your take on the latest, your latest view on collection rates for your portfolios.
Sure. So in each sector, it's a little bit different, but I'll just talk a little bit about the major sectors. The one sector that has been very impacted has been hospitality. We have very little hospitality in our portfolio. Less than a fraction of 1%. So I won't really talk about hospitality, but the other two sectors that have been more impacted, as Peter mentioned, obviously retail and certain segments of retail more than others, and then also obviously office, just given the working from home scenario. We have a very strong portfolio that we think performs well in all cycles. So our rent collections actually have been quite strong across the sectors. So in multifamily, our collections have been in the high 90s. In the office sector, in the mid 90s. Industrial has also been in the mid 90s, and then retail has been around 70%. So you can see that other than retail, all the other sectors are performing well. We have a very strong office portfolio, for example, primarily located in Toronto and Vancouver, with some also exposure in Edmonton and Calgary as well. But our tenants are very, very strong tenants, law firms, national accounting firms, other very strong tenants. So the collections on that front have been quite high. And as I mentioned earlier, we also have been supporting our tenants with the CECRA program, which really provides the government puts in 50%, we kick in 25% as the landlord, and the tenant pays 25%. And that program is really only available to smaller businesses, so it's not available to all of our tenants, but the ones that it is available to, we've been supporting them on that front, which has also helped on the collection front with smaller tenants.
Cecilia, if we look at your company, according to your second quarter financial statement, you've had collection rates of about 95%. Is that something you're looking forward? You're thinking that's going to improve, or can you give us your view on collection rates, please?
We're not seeing much of a difference in Q3 from Q2. Obviously, the final numbers are still to come, but from our conversations with tenants and what we saw for the months of July and August, one of the things that we did in Q2 that we don't plan to have continue beyond September 30th is we did provide some of our tenants a deferral option, particularly the ones that had not been established long enough before the shutdown to really have a customer base solidly lined up. And so we did offer deferrals. So you're right. In Q2, we collected 95%. We deferred 3%. And then the abatement, like what Tamara was referring to, we did participate in the secret program. And so 1.8% of our rent in Q2 was abated. The program, as everybody knows, was also extended for the 3 quarters in Q3, with September explicitly being the last month of the program. And so we expect a very similar breakdown between abated rent, so almost 2% in Q3, with more collected and much less deferred in Q3, so closer to a 98% collection. I expect we'll have some deferrals still. It just won't be the 3% that we had in Q2. I also believe that the government will implement another program. The details have been very sparse, and I don't know if it will involve some form of abatement on behalf of owners. It hasn't been clear yet, but our working assumption is...
Sorry, a program similar to SECRA or something different?
I don't know. The government has said that they were looking to implement something else. And so our working premise right now is that whatever that new program is, and hopefully that there will be details soon, but that we're assuming it will not involve any further abatements by the landowners or by the property owners. I don't know if that's a reasonable assumption or not, but that's what our working assumption is today.
Okay. Peter, for the your most recent financial statement, you anticipated 94% to 96% collections rate, and I believe that's excluding deferrals and tenants who are in the SECRA program. Is that about right? What's your view? What's the latest you can tell us on your anticipated collection rate?
I think that's approximately correct. I mean, we as a predominant retail landlord, the Q2 period for us, resulted in the April collection levels being perhaps lower than you would prefer them to be. We ended April at approximately 70% being collected. Now, keep in mind, our shopping centers are open format shopping centers, so we don't have, with the exception of 2 or 3, we don't have any enclosed shopping centers, which really should be viewed differently. But if April was the worst month for us, where we had 70% or so collected, we've continued to see demonstrative improvement over the last 6 months, such that, and I think we communicated this a few months ago, we would expect certainly by the end of Q3, when we're announcing our results, to be able to say that our collection levels are in that 94 to 96% range. And then when you add deferrals into that mix as well and account for those, I think it would be perhaps even higher. So, we're continuing to see businesses return to whatever that new level of normalcy might be, at least in the interim, until there's a vaccine that hopefully arrives soon. And those tenants are continuing to sort of find ways to grow their businesses, to attract customers into their stores and operations, and as well pay their rents. It goes also without saying that the SECRA program for small to mid-sized businesses in Canada, I think, was a godsend. Many of our tenants, and I'm sure my two counterparts on the panel as well, many of our tenants sort of were beneficiaries of that program, and it's worked very, very well over the last 6 months. But Cecilia's right; it's now appropriate to think that that 6-month time frame has lapsed, and perhaps there will be an alternative program soon introduced and announced by the federal government. But it's time for Canadian businesses, hopefully, to find ways of returning to some level of normalcy. And again, we're hoping that this vaccine that's been spoken about and talked about so much is able to be introduced into the general marketplace over the next 3 to 4 months.
And if I could just, we have seen COVID numbers ticking back up recently. What are your feelings about a second wave, and how do you protect for that? How do you think about that in terms of a risk perspective? Where are we in terms of second wave?
It's a good question. Certainly, again, given the nature of our assets, our retail assets, at least as open format shopping centers, I think there's a certain level of comfort that shoppers in those environments feel. We do have 2 office buildings as well that probably not unlike Cecilia's experience and Tamara's experience, we've modified again to assure those visiting or occupying those buildings to allow them to feel safe and give them peace of mind. And it would be our expectation, given the government's mandate, that all of us have a requirement to wear masks in open environments and in public environments, that finds its way to reduce the spread of this virus. I think also from the reports I've read, most recently, some of the challenges that we're now experiencing vis-a-vis a second wave are concentrated in particular areas, and there's perhaps some real social reasons for those increases in the virus seemingly spreading. But I think generally those increases don't appear to be coming from shopping centers. They certainly don't appear to be coming from office buildings, et cetera. So again, all of us are doing all we can and more to ensure that people who work, visit, and patronize our assets are comfortable and have a certain level of confidence that they can shop or work there without being infected with this disease.
Tamara, what would you say to that?
I would agree with what Peter has said. I do think that we're probably in the middle of a second wave now, as we seen an increase in cases. But I don't think the shock to the system will be as significant as the first wave. Both for us as a company, but I would say the community in general. I think like most companies, we have a playbook and protocols, for shutting down and reopening facilities. Our workforce has adapted to working from home and, have proven that they can work very effectively and efficiently remotely. I think the healthcare system is better prepared and more equipped to deal with an increase in cases and with, better treatment and more equipment to deal with serious cases. I think the knowledge, both in the medical community and the public at large, is much greater. We've seen the effectiveness of certain strategies, and we know that, as Peter mentioned, wearing masks and social distancing is effective in controlling cases. And I think our seniors and those most at risk are being better protected. And increases in cases, as Peter mentioned, are in certain areas, and I would say in the more resilient age category as well. So I think all those things, and the fact, I think that, there's a number of vaccines that are being currently tested around the world. I think there's reasons, to be hopeful that a vaccine will be available in the, not too distant future.
So the numbers are ticking up, but Canadians in general are better able to cope with it, and So almost like even if we do head into or are in the middle of a second wave, that the impact perhaps economically shouldn't be as severe. Cecilia, would you agree with that?
I would agree with that. I heard one of the health ministers, and I don't remember her name, comment that she felt that if and when there was a second wave, that the approach to a shutdown should perhaps be a little more, I believe she used the word surgical or more targeted, which I
Yep.
completely agree with. Let's really isolate and protect the most vulnerable. It's funny. I thought that the second wave would be precipitated by the return to school, but it hasn't been that case at all. It's interesting actually. I was always mentally prepared for that second wave to be once my kids went back to school. Um, Thankfully, it hasn't come from there, but it has come from, I think, other people maybe not taking it as seriously as they should be. So I think taking a more targeted approach, and to what Peter and Tamara said, more of a culture of acceptance around just wear your mask always, unless you're sitting by yourself and not within a 2 meter radius of someone else, or even if you are, just keep your mask on if you're out in public. I think that culture has helped. I heard one of the gentlemen from Brookfield comment that they were able to fully reopen their office in South Korea and I believe Shanghai. They were above 95% repopulation because there's just always been a culture of mask acceptance. And so people are very accustomed to it. And I think that'll be maybe one of the remnants of this COVID situation where, 9/11, the remnants was extra security at the base of various buildings, particularly in New York. I think the remnants from this will be it'll be more common to see people walking around with a mask. And I hope we can avoid a second complete shutdown, but that targeted approach to me makes sense and should allow us to keep a lot of things that are currently open